Good evening, everybody, and welcome to this special meeting of council. Tonight, we are considering the, God, where did my thing go? What are we doing? Is this it? Budget Education 101. Well, if we give our attention to the Acting Commissioner of Corporate Services and Treasurer, it's Nancy Sully, we will have Budget Education 101.
Thank you. Through you, Mayor Burton. This education session was set up to just provide an opportunity. I'm not sure. Can't hear? Ah. He's gone back there. Let me just see. Can you hear me? I don't know if is it working? Oh, okay. Can you still hear me if I'm standing back here, or do I? Yeah, okay. All right, I'll try again. So this meeting was set up as an opportunity to just delve a little bit more into the budget process and the components of the budget before we begin our budget meetings for the 2020 operating and capital budgets. So under Section 290 of the Municipal Act, we are required to prepare an annual budget. We can prepare it in the year preceding and have it approved, as we do in most years. The exception to this is in an election year. So in the year of an election, you have to actually approve the budget in the year the budget is for. So for 2020, we will approve it in 2019 so that it's ready for 2020. When we hit the next election, we'll have to do it into that following year. We're also required through Section 290 to identify all of the expenditures and revenues required to run the operations of the town. And the important point here to remember is that it must be a balanced budget. So revenues have to match expenditures. We are not allowed to prepare a budget with a deficit. We have to balance our budget. So before I get started, I thought it might be helpful just to remind everyone of the property tax bill. So there are three components to the bill, and council guidelines to staff are that an overall increase be in line with inflation. So that's the increase that residents will see on their tax bill, and that's based on the town share, the region, and education. On the residential side, the town share is about 41% of the tax bill, whereas on the commercial bill, it's 27%. So tonight, when I'm speaking about our budget, I'm really focusing on that 41% of the tax bill. So our budget's not just a budget. It is a key financial planning document. It allows us the resources to achieve council's strategic priorities, to deliver on mandated services, implement recommendations from our master plans. It also provides the vehicle to bring forward new service requests or increase to service levels that we're hearing from residents or demands for service. It's also a vehicle to engage our citizens. Our budget meetings are open to the public. We have open council meetings for budgets. We show all of the budget meetings on our YouTube site. We also have a budget open house that the budget chair manages. And we have delegation meetings that allow residents to come and speak to our budget. Our budget focuses on programs. So we use what we call PB2, which is performance-based, program-based budgeting. Our first budget prepared under this methodology, I think, was in 2008. And really what it does is it takes the focus away from your expenditure lines, so personnel, material supplies, etc., and focuses more on the program and what you're going to expect to receive from that program. So not only the resources required to operate that program, but also what the outcomes are. So we do include performance measures for all of our program budgets. We show a 5-year trend in the business plan, so you can see how we're performing over time. And as we've gone since 2008, we've refined our measures. So we started out with quite a few. For members of council that will remember back to 2008, our budget document was quite thick and we had numerous measures. We've really refined those over time to try and ensure that they really do measure the outcomes that we're achieving through these programs. The other thing we've done is we've received platinum certification from the World Council on City Data. So that's 100 measures, ISO standards. we have incorporated those wherever possible in our business plans because they're measures that allow us to compare ourselves to other municipalities to see how we're doing. They are verified by third parties, so they are consistent with the way others are measuring their results. So how do we develop our budget? Our budget's based on programs, and there are two components to the budget. There's the base budget, and there are new requests. So our base budget really focuses on maintaining our existing services. So it provides the funding for our existing service levels. It also includes funding for the annualized impact of previous decisions. So if a new service was introduced mid-year in 2019, then you'll see the annualized impact of that in 2020. Our capital-driven operating costs, as we build facilities, we increase our roads through growth, we have to account for the impact of maintaining those facilities and services. It doesn't provide for growth pressures on our existing services. It also does not provide for increased service levels or new services. So the second component is new requests. Our new requests, we have three drivers of new requests. We have growth, so as our town expands, we are required to offer services to our new residents, so there are pressures related to growth. There's increased service level demands. There'll be new services residents will expect. There'll be new requirements under legislation that we have to provide for, or new services that as staff we feel are important for our residents and for council to consider. We really have kept our new requests to a minimum over the past few years. Council has given us a guideline of an overall increase in line with inflation. That's really put a lot of pressure on our budget, and it doesn't really leave a lot of room for new requests, so you probably haven't seen very many of those in the past few years. And when we build our budget, our departments start their budget process in the spring. They work on their budgets throughout the summer. They have a financial analyst that assists them as they're going through the process. And really, they're looking at their program budgets. They're reviewing their past activity, their performance measures. They're considering the cost drivers that are affecting that program or service. So in the case of road maintenance, you'd be looking at the pressures for fuel, for transit, for fuel, things like that. We look at our contract renewals and what are the price increases. We look at strategic goals and what we need to deliver to ensure that we meet those, and the resources required to achieve our program outcomes. And then for new requests, those are things that are really considered necessary to achieve the goals required from council. So once staff has prepared the budget, the departments, it then goes to finance and we begin our review. So we look at the budgets from a corporate perspective. We look for accuracy, for reasonableness. We look at our cost recovery ratios to ensure that we're maintaining them, ensure that we're not putting more pressure on the tax levy versus our user fees. We then compile the department submissions into a town budget. We look at what is the overall increase, are we within the funding envelope that council has given us, and we prepare some packages for senior management review. Our CAO and commissioner review takes place usually late September and throughout October. And we're looking at the budget from a corporate perspective. We're looking at new requests to see if they're high priorities, if there's something that really does need to be recommended to move forward. We're ensuring that the budget is fiscally sustainable. We're not using one-time revenues to fund ongoing expenses. We're ensuring that we have the sufficient funding to meet the needs as we see them for the coming year. And we prioritize based on our council priorities. Once EMT signs off on the budget, finance then takes it away and prepares all of the budget documents. And then we begin our council budget process. So that typically takes place mid-November and into December. And as I said before, it is a public process. We have several meetings for review of the budget. We provide an overview of the budget. We have staff presentations, commissioner presentations. There are meetings for delegations, usually 2, and the budget is reviewed to ensure it is aligned with our strategic priorities. And the final recommendations of the budget committee then go to council, typically in December for final approval. And with the budget being approved in December, it allows staff beginning in January to hit the ground running. They know what their budget is, they know what capital projects have been approved, and they can start right from day one. So there are many program cost drivers that we have to consider when we're preparing our budget. We look at economic trends, we look at our personnel costs, new and enhanced programs, growth, and the pressures that they create on the town budget, municipal contracts, are costs rising greater than inflation? What do we need to consider as we develop our budget? So the next few slides are based on the 2019 budget, and just want to go through some of the components of our budget. So the largest expenditure category is our personnel services and benefits. That makes up 47% of our gross expenditures for the town. It includes economic increases. There's a large percentage of our staff that are unionized. We have to ensure that our union contract increases are incorporated in there. It includes benefit costs. Our benefits a lot of them are based on utilization as opposed to specific increases in them. We look at our new programs and staff. So while our personnel and benefit costs may go up higher than inflation, it also will include new employees required to deliver our services. So if we were to open a new fire station, 20 new firefighters, those are all built into that personnel cost. So often you will see that increase as being higher than inflation. Our materials and supplies account for 7% of our gross expenditures. These include items such as utilities, fuel, office supplies, construction materials. And again, often these costs rise at a greater percentage than CPI. So many of them are based on construction price indexes, which typically are higher than our CPI. Our purchase services account for 11% of our budget. These include contracted services such as software licenses, professional fees, insurance, printing costs. And our internal charges account for 6%. So internal charges are charges from one department to another. So if we looked at our fleet budget, our fleet is what we call zero. It goes to a zero bottom line. So all of the expenses in fleet are allocated out to the program areas using those vehicles. It allows us to show the true cost of delivering that program and ensures that we're managing our resources appropriately. Our financial expenses are operating expenses. These would include things like debt charges, grants, and bank charges, things like that. And our final component is our minor capital and our transfers to reserves. So the transfers to reserves are what are used to put money aside to fund our capital budget. I'll speak a little bit more about that when we get to the capital. But the contributions to reserves are budgeted in our operating budget. Minor capital are typically smaller expenditures under $10,000, which are actually budgeted in our operating budget. So on the revenue side, our revenue equals our expenses. In the case for 2019, $337 million. I will speak to the largest two components of that, our taxation and user fees in a moment. But first, I just wanted to touch base on our other sources of revenue while I have this slide up. So those include investment income, penalty and interest on taxes, our hydro revenues, payments in lieu of taxes, supplementary taxes, as well as our internal recoveries. So when I said we have our internal charges, we're charging departments. The other side of that is our internal recoveries. So that section includes our hydro revenue. That includes our dividend. That includes our lease payments, interest on notes. Our investment income includes not only interest on our investments that stays in the operating budget, but also what goes over to our capital, into our equipment reserves. So taxation is the largest component of our revenue. It is 59% of our revenue, and it really is the net levy after all other revenue sources. So if we take 100% of our expenses, if 41% of it is coming from other revenue sources, and the remaining 59% is levied through taxes. Our tax rate is calculated by dividing that net levy by our weighted assessment. And our assessment classes have different weights depending, resident, multi-res, commercial, industrial, all have different rates. Our tax base, the weighted assessment based on 2019, was 82% residential and 18% non-res. And again, our share of that total tax bill is 41%. I should highlight as well that our growth in assessment. So assessment growth, every year in the budget, we'll have a number in there for assessment growth. And that's really increased revenue coming from either new properties coming on the town, so as new homes are built, the assessment we get from that, or expansions or improvements to existing properties. It isn't based on reassessment. So every 4 years when we go through current value assessment and our homes are reevaluated or reassessed, that does not give us increased revenue. We then calculate what's called a notional rate, and the actual tax rate goes down. So we're collecting the exact same amount of revenue with that higher assessment base. Assessment growth, though, from new assessment actually gives us that one-time new revenue coming into the budget, after which it then stays into the base. Fees and charges account for about 22% of our budget, and our user fees are set based on our user fee policy. So they look at the full cost of delivering that service. That includes not only the direct costs, but also our support costs and corporate overhead. And then it looks at the degree of cost recovery depending on how much of the service, the benefit of that service, is derived to the person applying for it. So in the case of a building permit, someone coming in for a building permit, they're getting 100% of the budget or the benefit from that. We're looking for full cost recovery on that service. Someone coming in to use a recreation program, an aquatic swim lesson, there's going to be a much lower cost recovery there because there's a community benefit. There's a life skill. It's not something that we're looking to recover the full cost of. And they vary depending on the amount of benefit to the person. And again, what we have to really watch our user fees, because if we lower our fees, we're shifting more of that cost onto our tax levy. And one of the things we have seen in our citizen survey is that residents say they prefer the user fees versus tax increases. So we try to balance that out as we go through the budget process. Up until now, I've been speaking about mostly the operating budget. I want to shift the focus a little bit to the capital budget and our long-term financial forecast. So this is a key financial tool that we use, and it's really an integral part of the budget process. We prepare a 10-year operating and capital budget forecast. So we're looking not only at what the capital components are, the projects over the 10 years, we're looking at what the operating impacts are going to be based on those projects. We're also looking at the impact on our tax rates, on our reserves and reserve funds, as well as our debt levels. So our operating and capital budgets are a little bit different. They both provide for services and programs for the town, but the types of expenditures in each and the sources of financing are different. So our operating budget provides for the annual cost to deliver our services and maintain our infrastructure, whereas our capital budget provides investments in infrastructure or assets that provide a long-term benefit. Projects in our capital budget can span many years. They can take 2 or 3 years to be built. You're building a new community center. It's not necessarily done in that 1 year. We do cash flow those projects, so you'll see in the budget there'll be an amount for year 1, year 2, year 3, as we expect that infrastructure to be constructed. So this slide just highlights the interdependency of our operating and our capital budgets. Our operating budget provides the funding sources for our capital. So our capital levy, our contributions to reserves are budgeted in the operating budget. On the flip side, our capital budget drives operating costs. So as we build new facilities or infrastructure, we have to fund those ongoing costs of operating and maintaining them. We also have to look at debt charges. If there's debt financing in our capital budget, then we have to ensure in our operating budget we're accounting for those debt charges as part of our expenses. There are 3 main sources of funding for our capital budget. The first is our capital levy. We have, since I think 1998, been adding 1% to the tax levy each year as a capital levy. So if you think about our increase, our guideline of an overall increase in line with inflation, for the town that's about 3%. The first 1% is actually going to that capital levy, which leaves us with just a little over 2% to manage and fund all of our town programs. That capital levy is a growing source of funding that we use to maintain our infrastructure in a state of good repair. It provides funding towards our town share to our development, our growth-related projects. It also provides funding for community enhancement projects that need to be funded in our capital budget. Our reserves and reserve funds are used to fund our capital projects as well. So in the operating budget, we will transfer money into equipment reserves, into building maintenance reserve. We then draw on those reserves to fund the projects, the infrastructure renewal projects in our capital budget. So it's a major funding source of our infrastructure renewal. Our debt is another source of funding for a capital budget. If we issue debt, it cannot exceed, the term of the debt cannot exceed the life of the asset. We have used very minimal debt in our capital budget. That ensures that we maintain flexibility. The more debt charges you have, the more pressure on your operating budget, the higher the percentage that has to go to maintain and carry those debt costs. But there are instances where debt is an appropriate funding source for a project. If it's a project that's going to benefit users well into the future, it's a way of spreading the cost of that to future residents as well as existing residents. We've used it for things like our LED streetlight conversion, where we've used debt to fund the actual infrastructure, and now the savings we're receiving from the utility costs are actually funding those debt charges. So there are some very appropriate uses for debt in your capital budget. Our reserves and reserve funds, those are funds set aside at the discretion of council. We do apply interest to our capital and equipment reserves, and really they are set aside for our capital purposes. Reserve funds are a little bit different. They are segregated from our general funds. They must be used for the purpose for which they were developed or set up. And the obligatory reserves are considered deferred revenue. So those would include development charges, gas tax, cash in lieu of parkland. There are very specific rules around the use of those reserve funds as well. Because they're considered deferred revenue, what that means is you only earn it as you can only use that funding as it's deemed to be earned. So the way it's earned is you spend. So if you have a capital project, a new road that's a growth road, you budget for development charges, you can only transfer the funding in from the reserve as you've incurred the expenditures. So you wouldn't transfer the whole amount in. If you've only incurred 50% of them, of the cost, then only 50% of the funding goes in at that time. And they are almost exclusively for capital purposes. So just one, I couldn't do a budget presentation without adding a slide on Bill 108. I talk about reserve funds, and they are a huge component of our capital funding source. And our development charges are a major source of funding for our growth-related projects. And with Bill 108, there is a lot of uncertainty right now as to what that's going to do to our development charges, and specifically on our soft services as well as our parkland. So while I said we bring forward a 10-year capital budget, this year we're only bringing 1 year because of that uncertainty. So you'll only see the 2020 capital budget. We'll come back with a long-term forecast once we understand the regulations and develop our community benefits charge bylaw. We'll come back. But at this point in time, there is so much unknown with it. We haven't been told what the cap is. They haven't given us the transition rules, so there's a lot of uncertainty. And I wanted to end the presentation with just a little video. We have this on our website for residents, and you may find it useful if there are residents that really don't understand our operating capital budgets. It's just a very simple presentation explaining the budget in sort of layman's terms. So I thought I'd just show it to you now, in case you haven't seen it. And hopefully it works.
Okay, I'd like to help you understand how your town develops its budget. We always hear about them, and often this can feel like another language altogether. Before we get started, there is important information you should know. Ontario towns like Oakville receive only 9% of all taxes collected, but are responsible for over 50% of the infrastructure. Let's start by looking at what the word budget means. Simply put, it's a planned, itemized summary of money that is coming into the town and how that money is spent for a specific period of time. It's very important to note that provincial government legislation in Ontario states money coming in equals money going out, also known as revenue equals expenditures, or a balanced budget. The town of Oakville provides more than 90 services to the citizens of Oakville, so town council and administration always have to make difficult decisions to ensure this balancing takes place. There are two main components of the budget when looking at the money going out side of the scale. Operating pays for all the day-to-day activities of the corporation. This includes items such as salaries and wages, utilities, supplies, fuel, and insurance, just to name a few. The capital budget pays for all the new big investments or the rehabilitation of current assets under the town's control. So let's focus on how the town collects to pay for all these services. For every dollar that comes into the town, 63 cents comes from property taxes, 1 cent from grants and subsidies, and 35 cents from user fees and other sources. So, now we've learned what a budget is, how cities collect money, and how they spend it. Now let's take a look at how these pieces work together. Money comes in through property taxes, grants, and subsidies, and user fees. The money collected is required for both the operating and capital budget. We've already talked about the operating budget, including day-to-day expenses, but it also includes money for funding capital budgets. The capital budget pays for all the new big investments or rehabilitation of current assets under the town's control. This connection is made through three methods. The capital levy method reflects a pay-as-you-go approach. The reserve fund method, which reflects a planned, save now, acquire, or use later approach, and the debt payment approach, which represents borrowing. The way the town balances its budget is it adds up all the costs to deliver services, then subtracts all non-tax revenues such as user fees and charges, grants, and interest earnings. The difference is the amount required from property taxes to equal a balanced budget. Okay, so let's recap. 1. A budget is a plan for money coming in and money going out. There are two building blocks to the town budget: operating and capital. 2. The operating budget is like you paying your house bills to keep the lights on. Just like in a normal household, our bills go up with inflation and other economic pressures. 3. The capital budget is like your major outlays: vehicles, house renovations, etc. 4. Money comes in from three sources: property tax levy, user fees, and grants and subsidies. 5. Money coming in is used to deliver over 90 services to town residents. 6. Town council and administration, with the input of the public, decide how to best balance the town budget guided by provincial legislation. And that is how your town develops its budget.
Alrighty, questions? One of the most common difficulties that the public and new counselors that I've seen over the years have is to understand assessment growth, and Nancy gave a good explanation of it. But if you have any confusion about it, or you wake up another day and you have some wonder, you wonder a little bit about it, please understand that staff are happy to give you a deeper explanation of it if you ever want it. I've especially seen assessment growth misunderstanding at the regional table, but actually not so much here. Councillor Dudek.
Thank you, Worship. And actually, having seen this video, which I think is excellent, could we wrap our head around providing something similar to sort of outline how a person's taxes are arrived at and deal with that assessment? Because the biggest misnomer I hear, or urban legend, is it's a tax grab from the town. They're going after this, that, or the other thing. Or the reason my taxes are going up is because of your budget versus their assessment. And so that's sort of, difference for people to understand. No matter how you try to make it simple, they still come out with more questions.
Because that's related to the way the provincial legislation uses our property tax to subsidize growth. The video is even more important because it really has to explain both those things so that people get it, that far from a tax grab on behalf of the town, it's actually very protective to the degree it can be of the resident, while at the same time picking their pocket for the developer.
And I think that also leads into the DCs in terms of understanding what soft and hard services are and why we are so adamant about making growth pay for itself. And several people have called saying, well, I thought they already did, and trying to break it down is hard.
That's a great idea. Councillor Sanju.
Thank you, Mayor Burton. So like, if I could ask you to go back to your slide that shows the donut and the 40-something% for personnel.
Oh, sure.
Krispy Kreme.
Yeah, Krispy Kreme. I just have a general question here. So when we're looking at personnel services and benefits, do we also include like legal expenditure here? So like when we have our QP negotiations and things like that, is that also included in personnel
No, they're
benefits?
not in that line. That is just salaries and benefits for
Got it.
staff, and it is budgeted per employee. So we actually look at, as someone's moving through the grid, if someone, if someone leaves, for instance, a firefighter, as they progress through, when they, oh, sorry, you can't hear me? Can you hear me now?
You really have to speak directly
okay.
into that mic for some reason.
Sorry. So no, it doesn't include legal costs. It really is the salary and the benefits for employees, right down to the employee. We budget fairly exact. So if you look at a union member who they progress through a grid, they're at the top of their class when they retire, their budget for that salary would be whatever they were making. As people retire, we then move the budget down, so it reflects that. But any costs for legal or anything like that, that's in our other financial expenses.
Got it. So that's a completely different button.
Yeah.
That's over on the left.
Yeah.
Okay, that makes sense. Thank you very much.
Okay.
Thank you, Your Worship. Nancy, not to get in the weeds, I'm just going back to the performance measurements. And I know in my past life too that it was unbelievable, the criteria we had to put together on that. Do we indicate anywhere with respect to performance measurements where there are programs that we've eliminated with respect to it doesn't meet those criteria in the performance measure? Do we indicate those services that we eliminate or modify or throughout the process?
Through you, Mr. Chair, I think we do that more in the presentation. So sometimes in the book, if we were measuring programs and it's changed over time, they will indicate that in the business plan. And often they'll talk with what their priorities are for the next year. And through the commissioner presentations, they'll speak to that if there are going to be program changes. So if I think of transit where he'll modify routes or eliminate low service routes, that will come up during the budget process so that there's transparency.
Councillor Adams.
I just have a little tiny niggly thing. There was some good conversation about creating videos for some other educational purposes. The one that we have is actually begged and borrowed sort of from, is it?
City of London.
Yeah, London, thank you. And so if you look at it, in the details of it, that's why they have a higher percentage of their revenue coming from taxes shown in the video than we actually have in our budget. So the video says 63%, I think it is, and our actual number is 59. So if you look at the two and you go, hey, they're not quite the same, that's why.
Well, perhaps we can,
Sorry, through
we'll make
you-
our own.
No, through you, Mayor Chair, it is based on hours, so that's based on $1 and the dollar of your dollar, what's going, but 59% of our expenditures are funded through taxes, so it's a little bit different.
Okay.
It's a definitional problem.
definitional
I
issue.
think it is.
All right.
And it's probably the same issue around the number of business units that are described. Because if you said 90 business units, you might not see the same number elsewhere.
It includes activities, everything, so that is based on our information.
All right. Well, thank you, everybody. Oh, Councillor Hazeltine.
When we get the budget book, do we get a breakdown of some of the savings that are projected based on some of the lean work that's been done this year?
You will receive that, yes.
Okay. And my other question is, do we get a definition of, an identification of by department of the gaps, the staffing gaps that have occurred in the year?
Through you, Mayor Burton, you mean gapping,
Yes.
So we budget corporately for gapping, so in our corporate revenue and expense section of the budget in the program, we actually budget an amount for gapping, $1.2 million, and that's to account for all the turnover during the year. We have a vacancy management program where if there's a vacancy that occurs, there's a whole process departments have to go through. They get considered by the executive management team to decide whether to fill. A length of time that those vacancies are there, we actually budget that gapping and take it from the department budgets. So we account for it that way so that we're not levying for something that we're not going to spend, because we know traditionally there's always turnover. If there's a reduction in the number of FTEs for some reason, a program change, you would see that in the schedules for the staffing. There's a chart that'll show you full-time and part-time FTEs, so you would see that in the appendix. I'm not sure if that answers your question.
No, but it raises more, but I'll hold those for now. Thanks.
Okay, but if I understood what you said, and let me just check with you to see that I understood it. You're saying that gapping is forecast and accounted for in order to not have a hidden source of savings.
That's correct.
Thank you. I ran a television network. Boy, do I ever know. Councillor Chisholm.
And I guess the question is, with the FTEs who you're just speaking of, they don't decrease, they're just reallocated to different departments or different within the corporation?
Often that's the case.
Thank you.
All righty, Councillor Robertson.
As we go into this, do we know if all contracts have been settled then for all unionized workers as you prepare for things like that?
For the contracts that haven't been settled, I think there's only one, 1329, QP 1329. We have put a provision in the budget because those negotiations are ongoing.
Thank you very much. If there are no more questions, is there a mover and seconder to receive the session? Councillor Duddick, Councillor Elgar, all in favor? And that's carried. Thank you, everybody. Where did I put my other page? Did I give it to you? I think oh no, I know what I did with it. I need to borrow yours.
Yes, you do.
All right. We now need a counselor, we need two counselors to move and second the confirmatory bylaw. And Councillor Lischina and Councillor Grant, thank you for that. All those in favor? And that's carried. And that concludes the business that brought us together for this session. It's been great working with you. Thank you for your questions, your time, and your attention, and we are adjourned.